30 on the dot. So welcome all. Very pleased to see you here. And I think it's no surprise that we have a very solid, good number of registrations, more than 60, and that we've got now 30 people or so online. So that's excellent because our speaker is well-known club member Ian Harper, um, member of the Reserve Bank board until very recently, and now with the split in the board, he's a member of the Reserve Bank's um, Monetary Policy Board. Ian has been in that position for a number of years, and we've benefited substantially from having his insights, which have to be very carefully timed so he's not telling us anything that hasn't been recently published by the bank itself. And Ian, I hope you don't mind, but I'm going to mention that his last performance here has already been agreed. He's going to speak to us in August after the August board meeting, which will also be his last.
Mm.
Then
That's
he'll
great.
be free to go consulting or go to the beach, whatever he likes to do. So, so it's my pleasure to welcome Ian. I just want to say, Ian, as you know, his CV, his bio is given in full, and I'm not going to read it out, but all I can say as a fellow economist, it is very enviable. He is one of the stars of our profession. So over to you, Ian, on the topic of monetary policy, the economic outlook. And not only that, but also the financial stability report, which is quite important, not necessarily for Australia immediately, but because of events happening internationally and the possible contagion if anything should happen in the United States. Thank you very much, Ian. I'm handing over to you. Welcome,
Great.
everybody.
Yes, thank you, John. And yes, welcome members and guests. Privileged to be asked to speak about these matters today, and thank you for joining us. As John has said, what I propose to do is to take you through, if you like, the highlights of the two most recent documents the bank has made public. One called the Statement on Monetary Policy, which is published twice a year, and the other is, the statement's published quarterly. The other is the Financial Stability Review, which is published twice a year. One obviously deals with the outlook for the economy, both globally and domestically, and the Financial Stability Review, as the name implies, looks at international and domestic financial stability issues. I'll emphasize the Statement on Monetary Policy, but we'll finish up with some comments from the review at the end, and then I'm happy to take questions if that's the way we do things. So, John, I'm about to share the screen now, and I'm hoping that everyone can see that. Is that right, John?
Yeah, absolutely. Yep.
Terrific. Okay, thank you very much. All right, so I want to, there we go, right. Firstly, deal with the global economic conditions as they're outlined in the statement. And the very first chart to show you here is an interesting one because, of course, many people had feared, myself included, many of my professional colleagues, that the US administration's decision to apply really very high tariffs relative, as you can see from that chart, to tariffs that we've seen really reaching back into the 1930s. The last sort of tariff hike of this type was the Smoot-Hawley Act back in the 1930s. And you can see since certainly the Second World War, and much more recently, the tariffs have not been much of a thing until very lately. So given a rapid change in what is essentially a tax on imports and a tax on trade for the United States, one of the world's largest economies, and not necessarily the world's largest trading economy, but certainly large enough in terms of its domestic demand to make a difference, that we were expecting that would have a knock-on effect. As it turns out, that has not been as dramatic an impact on the global economy, let alone here in Australia, as many of us had feared. There are effectively three reasons for that. The first is that the announced tariffs have turned out to be far more dramatic than what's actually been applied. The administration has retreated from some of its more dramatic tariff impositions and revised things as recently as we know in our own case with the removal of the tariffs on beef exports. That's relatively minor in the scheme of things. but there have been quite dramatic reductions in what's actually happened. That's the first reason why the effect has been nowhere near as bad as it would have been had what's depicted in this chart come to pass. The second reason is that the Chinese in particular have very effectively sidestepped this swipe. They have done a neat two-step to the side, and the punch has gone straight into the open air. You can see here from this chart, just looking at the red line, how Chinese export volumes have hardly been affected at all. If I were to show you another chart which showed Chinese export prices, because you might be thinking to yourself, oh, well, the reason that's happened is the Chinese have had a fire sale of all of their products. That's also not true. So the chart on Chinese export prices shows more or less the same trend. So the Chinese haven't lost their momentum at all. How they managed that? They've redirected their exports.
Sammy, how are you, mate?
Sorry,
please.
I'm just about to go on.
Sorry, Ian. Who's speaking? Please turn off.
Go, but
yeah, Patrick.
So I probably won't see you on the weekend.
Yeah, I won't either.
Yeah. Don't touch next.
Maybe someone can send Patrick a note. Right, he's fixed. Okay, so as I was saying, the second reason why the impact of the the American tariffs hasn't been anywhere near as dramatic is that the Chinese have managed to sidestep the influence of this, primarily by redirecting their exports elsewhere into East Asia. Unless you think, yeah, well, it's just gone via Vietnam and other places back to the United States, there's no evidence of that, no evidence of re-exporting at all. This is straight trade diversion into other markets. So elsewhere in Asia and obviously Europe and the UK. So the Chinese have managed to avoid the impact of what was essentially, I think, a series of tariffs intended for them. The third reason why it hasn't really affected this is that unlike the episode in the 1920s, leading in part to the Great Depression, there's been no reciprocal beggar thy neighbor tariffs imposed by other jurisdictions. So I think that's nice to think, John, that people learned the lessons from their economic history and what countries didn't do, the large countries being the most important ones, was to meet the imposition of tariffs by the United States with equivalent tariff impositions of their own, which would have been mutually immiserizing, beggar thy neighbor in the real sense. So the bottom line here is that as far as the global economy is concerned, the outlook has been much more sanguine than we had feared it would be back in April for those three reasons. I'll come to the Australian economy in a minute, but of course our economic fortunes when it comes to our international trade are primarily driven by what's happening in China. Our economy is linked with the Chinese economy on the external or trade side. So if the Chinese have avoided the impact of this, then so have we, which is also broadly true. The direct impact on Australia of what's happened in the US with the imposition of tariffs was minor even before the reduction in beef tariffs, because the fact is we don't do a lot of trade with the United States, and the US operates a trade surplus with us, or us a deficit with them, as most people would know. Now, notwithstanding that fact, it's still true that the global economy, the international economy, is slowing. Now, the main reason for that is the impact of economic uncertainty that has surrounded all of the developments, particularly in the United States. And that uncertainty, as people would realize, has its own impact, even if, in fact, the event turns out not to be anywhere near as bad as people had feared. Nevertheless, fear itself can be the enemy, and you can see the impact of that here across these economies in this particular chart. So on the top bar there, you've got the dots, which are average rates of GDP growth for the decade 2010 to 2019. And then the red bars, of course, are the most recent readings for GDP growth in those economies. So with the exception of the Italian economy and the Japanese economy, all of the other economies are growing much more slowly. Our friends across the Tasman considerably more slowly than the average growth experienced over that decade. So the global economy is slowing. There's no doubt about that, including the US, as you can see on the right-hand side of that chart. The other expression of the same thing is what's happening to unemployment rates. Again, you can see there The black dots are the reading in December 2022, and the blue bars are the most recent readings. And again, in every case, apart from the Japanese, well, the Italians in particular, you can see that unemployment is rising or has risen relative to where it was back in 2022. So the US economy, along with the global economy, is slow. And the main mechanism for this is the uncertainty surrounding what has been happening with the US administration, rather than some things that it's been actually doing, although that hasn't had zero impact. The big impact is the impact of uncertainty on people's consumption and reinvestment. The other thing, of course, that's tending to slow things up is what's been happening with inflation. So inflation obviously affects the cost of living, and cost of living increases will reduce consumption. And as consumption, which is typically about 60% or maybe a tad more of the economy, as consumption goes, so goes the economy, because of course then producers, seeing the outlook for consumption falling away, they start to worry about their sales and start to pare back on investment, and so the whole thing can slow down. Now, if you look at this chart across those economies that are mentioned there, you'll see two things. Firstly, if you look at the red line, then you see how the red line, which is the headline inflation in those different economies, measured a bit differently in each case, is in a number of cases still above their targets, which are noted there in the chart by the broken line. You can see the UK quite considerably above its target. The Canadians, for instance, and the Europeans are on their targets, more or less. But you can see then the other two lines, the yellow line and the purple line, they show you that it's a very different story for services than it is for goods. Goods being the yellow line and services being the purple line. What that's telling you, and you'll see the same story is true for us in Australia, that inflation is persistent across the global economy, and its persistence is essentially driven by what's happening in services, not goods. So even though the goods trade, which is primarily what's affected by the imposition of tariffs, hasn't been as dramatically affected as we might have expected, and even though it's not been the case that the Chinese have felt the need to have dramatic discounts in order to shift goods which they can't now sell to the United States, that's broadly not happened. Nevertheless, you can see that the growth of goods prices, with the exception there of the Japanese, has essentially been below where inflation targets are. So inflation targets, if they're being met, or even if they're being exceeded, that is being driven basically by services prices. Now, services are typically not traded. The great bulk of services are not traded. Think of your classic sort of haircut, not traded. And so the price outlook for services is driven by domestic wages and domestic conditions. And here in Australia as well, the same pattern is there, as we'll see in a moment, that this sort of pickup in the rate of inflation domestically here is effectively a services story. Difficulty with the services story is that that is effectively about wages. It's about conditions domestically. And on the one hand, you needn't be concerned that you're going to import inflation, but we're not importing deflation either. The inflation we're experiencing is essentially homegrown. And that is also true of the United States. As you can see here on this chart, you've got, in the US case, inflation rising. The United States tends to measure inflation, well, its target is expressed in terms of what they call the PCE, which is the private consumption, consumer expenditure deflator. Anyway, it's a measure of consumer inflation. You can measure a CPI, but they don't target the CPI. Anyway, you can see there that inflation has been rising in the United States from its more recent history, and economists would predict that that would go further. To be fair, inflation in the US has not risen as far or as fast as we thought it would, partly again for the reasons I gave you earlier on. The tariffs have not been anywhere near as dramatic in fact as they were threatened to be. Nonetheless, there are price rises still coming through into the US, notwithstanding the administration's attempt to try and jawbone that down. The lower part of the chart shows that that's being driven by goods effectively. So yeah, this chart doesn't show you what's happening to services inflation in the US, but it does distinguish US experience from that in the rest of the world. Here in the United States, it's goods inflation, which is essentially driving inflation. Wages are rising in the US, but if anything, unemployment's beginning to pick up in the US, and therefore there are concerns about what will happen to wages growth on the downside rather than the upside. But goods inflation in the US has been picking up because, of course, the intent of the tariffs was to substitute for cheaper imports, domestically produced versions of these different things here: appliances, furnishings, toys, and apparel. And almost by definition, the domestically produced version is going to be more expensive than the imported version. The idea was to try and promote domestic manufacturing and switching consumption away from imports towards domestic production. That will, other things equal, produce more jobs, that's true, but it will drive inflation, and ultimately, of course, it compromises growth. One can say that we know a bit about that here in Australia because we applied precisely that same mechanism for the best part of 70 years. Yes, it does keep employment up for a while until employers start substituting capital for expensive labour, and then it goes the other way, as it did with our motor vehicle industry. And ultimately, this self-imposed tax starts to reduce the rate of growth of living standards more generally. It does take a while, but we watched ourselves slip over a 70-year period in economic history, down from being sort of arguably number 1 or 2 in GDP per capita at the turn of the 20th century. We were down to number 17 or 18 by the time all of this started to get reversed in the 1980s. So I think economists are reasonably clear about where this ends up. And it's not a sort of happy story for the United States, at least economically. It would be our contention. And the US administration presumably has other objectives in mind, and that's a matter for it. But on the inflation and economic front, then we're still going to argue that tariffs are not a good idea. The theory has not changed, and the experience has not changed from that. Okay, let's now move domestically and talk about ourselves for a little while. Here's a chart which shows the history of Australian GDP growth, including in more recent times. And you can see there from the chart that we've broken, or the bank has broken this out, essentially into sources of public sector demand, which are marked in red, and private sector demand in yellow, and net exports minus imports, which are the other component of domestic GDP growth. For the most part, as you can see, we're basically importing more than we export, which is sort of neither here nor there. As far as the economy is concerned, it means we're having some foreign investment, which is a good thing. But what's been driving domestic growth in recent times has been public demand. So those red bars have been doing a lot of work relative to the yellow bars, and that has given people pause for concern. You can't continue to drive growth in the economy simply by employing more and more public servants and expanding public investment. That's not to say that it shouldn't be done at particular times, but you just can't continue to do that. Well, what the chart is showing is that is now changing. So two things are happening. The economy is recovering. Its growth is returning to more normal levels, at least for more recently normal levels. If you look at the black line, you can see that relative to where Australia has typically been over the last couple of decades, it doesn't even look as though growth will recover to the sorts of levels we experienced over those times, let alone in some of the really boom times that you can see there in the chart. Clearly, the pandemic is an unusual experience, but growth is recovering, but to relatively modest levels. We'll see that in the forecast. But the good news is that the growth that we are experiencing is increasingly being driven by private demand off the back of the growth of private consumption. That's recovering, not just because of tax cuts, but because now with inflation much closer to the target, real wages are again growing, and real household disposable incomes are growing, thanks to things like the tax cuts. And as real household disposable income starts to grow, people start to spend again, which is what is happening. As they spend, of course, businesses respond by doing a bit more investment, and the thing starts to pick up again. So that is happening, but at relatively modest rates. So as far as we're concerned, yes, we are growing, and we're growing by a sufficient amount to keep unemployment below the natural rate. We're also growing sufficiently fast relative to the productive capacity of the economy to mean that inflation is still an issue for us. Before I get there, I talked about trade before and said that, as goes the Chinese economy, so goes our trade volumes. Now there, of course, we're not exporting a lot of services, but we do export services, you can see from the chart. The big deal for us when it comes to exports is resources. That chart up the upper left-hand quadrant there in yellow shows you that effectively the Chinese, as I said, have sideswiped the impact of tariffs on them. Resources demand has not budged from where it's been, and commodity prices, if I were to show you that chart too, you'd also see that commodity prices have been sustained. So those two things are very important for our ongoing growth experience. But across the spectrum there, whether it's manufacturing exports, we do manufacture advanced manufacturing goods, and some less sophisticated stuff. Manufacturing is not a big deal, but it's been growing. And you can see there rural exports as well as services. So the story for us is the same thing. We have not been affected by any reduction or threatened reduction in trade as a result of what the US has been doing, and that's good news for us. Now, the labour market's a sort of slightly more complex story. Here's a set of charts which show you unemployment rates, underemployment rates, participation, and the rest you can see on the chart there. Really, it looks like sort of not a lot has been happening if you're casting your eye across to the right-hand side of the chart. And the bank spends a lot of time thinking about what is happening in labour markets for two reasons. One, the unemployment rate is one of our targets. We have to, by law, try to maintain full employment, and that means to keep unemployment at a rate that economists call the non-accelerating inflation rate of unemployment. Some people call it the natural rate. Other folk don't like that term. But what it means is that it's a sustainable rate of unemployment. If the economy has unemployment that is below that for too long, that is inflation. The labour market is too tight. And on the other hand, of course, if it's above that rate, then there's a needless spare capacity in the economy, and not to mention the human costs associated with people being out of work for lengthy periods of time. Anyway, what you can see there, really at the time this chart was drawn, unemployment had bumped up from 4.3 to 4.5. And now it's subsequently come back down again to 4.3. But we did a fair amount of sort of agonizing at the bank as to whether this increase from 4.3 to 4.5 meant, as some people were suggesting, that we'd overdone things, that it was time to start easing monetary policy. And, here we are, the chickens are finally coming home to roost. Well, we didn't think that they were coming home to roost at the time of the most recent board meeting. And if you're following these things closely, you would have read the minutes of the most recent board meeting, which were published, I think, today or yesterday. It might have been today. If you followed that, you'll see exactly where we were at. And that is that we didn't think that meant that monetary policy was too tight. And that was one reason, not the only one, but why we didn't move interest rates from where they are. We think that most of the unemployment, to the extent that those numbers, they bump around a bit, but to the extent that if you said, well, all right, unemployment's been picked up a little bit, what was going on? What was going on was what was happening effectively, as we can see here in the red line. I mean, it's all marginal stuff, folks, but the red line shows a slight reduction. That's the employment to population ratio. And it's sort of backed up by the yellow line, job finding rate of unemployed, which is the number of people who are unemployed who are actively looking for work. Right? Now, those two lines together, effectively, we interpret it as saying that people were leaving the labour force. Not in large numbers, but they were leaving from employment back into simply being out of the labour force. Why? One argument was because real disposable incomes are rising again, that the person in the household who was taking a part-time job, for example, to supplement household finances has decided, well, that's not necessary now. The balance between trying to pay for childcare and the hassles of having a part-time job, not as necessary now. Maybe interest rates sitting where they are, having come down a bit, is helping household finances. People leaving the workforce. And those who were registered as unemployed at the time that the statistician asked them didn't claim that they were actively looking for work. And so that's why the yellow line is going down. Not actively looking? Well, no, because actually I'm about to give it away and go back out of the labour force. Anyway, if that's what happened, then just mechanically, just as a matter of arithmetic, the unemployment rate would have gone up. simply because the employment to population ratio went down a bit. Now, having said all that, it's gone back to 4.3, so we wouldn't want to make a big deal of this. The bank's view is that the labour market is still on the tight side, and I'll show you another chart to back that up in a minute. This is further evidence that the labour market is still tight. The quits rate and expected job mobility. So the quits rate is the number of people literally, leaving work voluntarily to go off and find another job, or they've got another job, and so they quit and they go. You can see that that's been going up. And expected job mobility is the result of a survey where people are asked whether they think they might change their job in the next year. And basically you compute that expected job mobility from the answers to that question, and you can see that's going up as well. So these two things going up are telling you that people are confident enough to be moving jobs in the current environment. And there's one thing that, as you can see from historical episodes in the chart, when things are turning down, people do the exact opposite. They hang on to what they've got. They don't start moving around. So that's further evidence that the labour market is still tight, or certainly healthy enough for people to be moving about. This is a chart slightly to the side, where, related to the earlier discussion about government demand and private demand, people worry about the fact that, well, yes, there's been employment growth, but it's all these public servants, right? The government is simply hiring a whole bunch of people, and that's masking what's actually going on. Well, as you can see from this chart, non-market employment, which covers not just direct public servants, of course, but people working for publicly funded enterprises in the not-for-profit sector, people, aged care providers, private hospitals and such like, they'll get picked up to where the government is primarily providing the money for the goods, even though it's not necessarily a public service or public enterprise even. But that's the purple line. So it is true that's been doing a lot of work, but no one's working or walking away from that fact. And the red line shows you what market employment is doing. Well, at the very end of the chart there in 2025, you can see that that is changing. So yes, non-market employment has been doing a lot of work, and in some cases even over against declines in market employment, which you can see there for a couple of quarters in 23 and 24. But that is changing, and we expect that will continue to change. And that is, part of the reason we think some of the employment ratio has gone down is that some of these jobs were in publicly funded areas in the not-for-profit sector, and people have pulled back from there. And market employment is now growing again as a result of the economy growing, which is important. We don't expect the demand for employment to grow as dramatically, though, because the private sector tends not to employ as many people per unit output as the public sector does, which is a fancy way of saying that the private sector has a higher labour productivity ratio than the public sector typically does. So as the public sector gives up its employment, we don't expect the private sector to take on everybody. Another reason why some folk are deciding, well, I don't need the second job, I'll go back home again. And they're coming out of the public sector effectively out of the labour force rather than into the private sector, which is why unemployment is not rising dramatically. We don't expect unemployment to rise much at all as a result of this switch from public to private. Now, this chart is an important one. So yes, the labour market is tight. People have got jobs, which is good. They've got jobs and their incomes in real terms are rising, and even after tax are rising, so they're consuming. That's good. The economy is growing. All that is good. Typically, people will look at the wage price index, which is the blue line in this chart, to get some sense of what's happening to wages in response to this. Now, the WPI is a very useful statistic, but it makes a number of assumptions in determining what's actually happening to wages. For perfectly good index number reasons, the index only compares like with like, and so it ignores increases in people's pay that are driven by promotions, for example, or by bonuses and commissions. All that is ignored, and you're just literally comparing a job and what it's paid with that same job and what it's paid another quarter later. And that gives you the wage price index, which when added up across the economy is a measure of what's happening to wages, and that's all good. However, that's not the whole story, as you can appreciate. People get paid more by getting promoted. People get paid more with commissions, sign-on bonuses, all of that stuff is part of the labour market. So if the labour market is tight, you would expect to see that broader measure of the costs of employing people going up faster than WPI, and that is what is happening. So AENA is average earnings measured in the national accounts. So this is another measure of labour costs, but this one includes the lot. We put the non-farm, it's just the non-farm sector, so the farm sector's out of there. But this is the bulk of the economy. And this includes all of the things you might expect to see if the labour market really is tight. Sign-on bonuses, extra overtime, all of the rest. And indeed, that's gone up. So it is true that remuneration for labour is growing faster than the WPI would suggest. Well, isn't that good news, you might say? Not necessarily. And this chart is a key chart. So just set aside the top line for the moment. Labour costs per hour is effectively what we've just looked at in the previous chart. That's your red line again. Labour costs per hour. And when you compare that with output per hour, which is the blue line, then you very quickly see towards, well, certainly at the end of the chart in the last year or so, but even beyond that, before that, but certainly the last year or so, you can see what's happening here, right? Bluntly, we're all being paid more per hour than we're actually producing per hour. So we're out there collecting fruit, if you like, and we bring back so much fruit per hour collecting, and then the employer is obliged to pay us more than the amount of fruit that we actually collected. And you think, well, how does that end up? Well, that ends up increasing nominal unit labour costs, which is the top line. Nominal unit labour costs is just the ratio of these two. So it's saying to you the actual cost of employing people is higher, right, than their contribution towards the output of the organisation per hour, which means that the labour is more costly to employ. It's not washing its own face. So what does the employer do in the face of that? One is not to employ as many people. Well, we can see that that's not happening at the minute. Why not? Because, well, demand is strong enough for that not to happen. What's the other way out of this? The other way out is for the employer to put prices up. And so we've begun to see an increase in producer prices. I haven't got a chart to show you that, but take my word for that. Producer prices have been rising off the back of these costs that you can see depicted here, nominal unit labour costs. And eventually, when margins have been compressed more than the sellers are prepared to accept, then these producer prices feed across into consumer prices. So this is a sort of more elaborate version of the proposition that because we have low productivity growth, and you can see in the chart down the bottom there, output per hour worked is growing at precisely zero and has been growing, in fact, negatively. It's been shrinking. So what each hour of labour is producing is going nowhere. And yet what we're paying ourselves, labour costs per hour, as you can see there, is at its historic average. That's growing much faster, which is producing an increase in nominal unit labour costs that's even faster again. So the lack of productivity growth is building into the system the seeds of inflation. And that is precisely what we see. So this is three different ways of measuring inflation. On the left-hand side, the bank has just excluded some volatiles there, fuel and such like, some administered prices and electricity prices, which isn't to say that they're not relevant. We're trying to get a handle on what the underlying rate of inflation is for the purposes of setting policy. You couldn't set policy on the basis of just jumping around with the CPI for obvious reasons. But if there's an underlying inflationary impetus, then that's right on the bank's radar screen. Well, look at the left-hand side of the chart, quarterly measures there that you can see, and you see which way that's headed. Take a 2-quarter ended annualized average of the trimmed mean, and you can see where that is headed. Take the year-ended version of the same thing, a weighted mean, right across the different components, and you can see where that is headed. So at the last meeting, coming into the last meeting of the board, we were at least I was as a board member, sort of thinking, well, the patient's doing very well here. This is actually coming out quite well, right? And what are we supposed to be achieving? 2.5% inflation, and it looked like we were there. And unemployment, full employment. Well, unemployment was 4.3, full employment's 4.5, so arguably we're sort of slightly on the right side of that. So, what's not to like about that combination? So just when you think the patient is doing fine, right? You go in there, take the temperature, look at the chart, bang, temperature's gone up. How do you like that? Temperature's gone up. So what's the message? Well, no, nurse, we can't change the medications just yet. Right? So the dose stayed right where it was. We haven't increased the dose because we've got to see how all this pans out. But it was quite sort of disappointing to see this spike in inflation, and that effectively is the reason why interest rates were not lowered from where they stood. That's why they stayed the same, if you like, at the last meeting of the board, and you can see that in the minutes if you care to read them. Well, what's doing this? Where's this coming from? Approximately, the explanations for this spike are housing costs. We need more houses, you all say. Absolutely. Get out there and build them. Yep, we're trying to do that. But it's not cheap. So the costs of building houses, now that we've got a bit more capacity to do that with some resources coming out of major public projects and a bit more land being released and a few things like that, which is sort of good news. Nonetheless, it is the cost of building dwellings, new dwellings, is rising. Not so much coming out of the rental market. You can see the lower panel there. Yes, rents are increasing, but the spike or the contributing factor to the spike in inflation was the costs of new dwellings. And then services, which we talked about earlier on. Here's a more micro look at the services inflation contributions. You've got household services up there. You can see from the bars at the bottom of that top left-hand panel or quadrant there that they picked up. Household services, that's literally your haircuts, home cleaning, vehicle repairs. You can see that under the double asterisk at the bottom of the chart. Meals out and takeaway, that's driven by wages. That's costs. That's the other red line we were looking at, driving the costs of meals out and takeaway. Finance and insurance, sort of steady, but still expensive. And domestic travel, well, there you go. You can see where that's headed as well. So you take those elements of services and housing together, and that explained why inflation ticked up in its measured amount in the most recent reading. Well, you might say, well, okay, but how do we know that that's permanent? Where's that coming from? The costs that are being built into the system because of what's happening with total labour costs relative to productivity, i.e. nominal unit labour costs, is a very important part of this story. So let's come to that right now. The board looks at these two measures. This one is of unemployment and the next chart is of output. I'll come to that in a minute. And each of these are based on econometric models that the bank uses for the purposes of analysing the data as they come in. And we don't just use one model because they're all built in different ways and have different assumptions and this and that. So what the bank staff bring up to the board are these summary charts of what the different models are saying. Now, the way to interpret the chart's quite straightforward, colleagues. If you just look at the top one, which is the unemployment gap, that is simply the difference between the actual unemployment rate and the natural rate. Now, these are forecast by models, so these aren't the actual data. These are outputs from the models. But what you can see there is because, in particular, the blue patch is down in the negative territory, what that is telling you is that the labour market is still tight, i.e. the difference between the actual unemployment rate and the natural or non-accelerating inflation rate of unemployment is negative. Right? We are still below the natural unemployment rate, and the models are telling us that the labour market is still in that position. I mean, not all of them. There are some which are above the zero mark, but you get the general idea. And the same story is true for underutilisation. This is about people wanting more work than they currently have. Well, that too is lower than its historical average. The reason for that is that the labour market is tight. There are far few people saying, or if you ask them, do you want more hours? Would you work more hours if you could get them? More people are saying, no, I don't want any more hours, thank you very much, than is typical. So the labour market is still tight. What about the output side of the economy? This is the difference between aggregate demand and aggregate supply. Same story, these are model forecasts. Now, it looks like there's a reasonable range of models telling you that, well, the output gap could be negative. Now, this output gap is the difference between actual output and what the economy is capable of producing. So if the thing is positive, that's telling you that we are above potential output. So you've got, steam coming out of various gaskets. This system is overheating. It's not sustainable. What happens if you keep running it like that is that it will give you inflation. That's what happens. And what monetary policy is trying to do is to control or bring the demand side of the economy back, bring actual output back closer to the economy's potential. Well, looking at that chart, what you can't read from the chart, but I can tell you, is there's only one model which is responsible for the negative reading down the bottom there. All the rest of them are on the other side of zero. But nevertheless, the bank needs to be honest in telling you what the models are saying. One of the models says we don't have an output gap. All of the rest of them say that we do. So these two things together, labour market is still tight. We still have an output gap, that is to say actual output is higher than potential output. Those two things together tell you the economy is still with an inflation tendency built into it. And there's the reason why interest rates weren't put down, folks. Where does productivity play into this? Well, productivity drives the aggregate supply side of the macroeconomy. So here's the trick, right? If aggregate supply is not growing much at all, because productivity is basically dead in the water, right? There's no growth in productivity, then it doesn't take anyone much imagination to work out what you have to do with demand to avoid demand being greater than supply. If supply is not growing, then demand has to be sort of sat on to make sure that you don't end up with demand being higher than supply and producing inflation. So if you're asking yourself, well, then monetary policy, it looks tight. Yes, it is tight. Here's the reason why. And when is that going to change? Well, the answer to that question is when this output gap and the unemployment gap disappear. When's that likely to be? Well, let's look at some forecasts and we can answer that. So these now are the official forecasts showing where the economy is likely to go. As you can see there beyond the forecast line into the right. This is the extension of the earlier chart. What's the story? Well, firstly, as I said, the bank is predicting that private demand will come back into balance with public sector demand to be much more like what it's been in the past. So that's good news, private sector coming back to life. But what's the growth doing? Well, that's at around about 2%, right? Growth in output, which is slow. We're used to growth that's higher than that, but with productivity growth where it stands, 2% growth is about as good as it's going to get. So 2% in the near term. And is that consistent with unemployment being full employment? Broadly, yes. There's, of course, a range of estimates, as you can see there. But this chart you read by saying, well, we're about 70% confident that unemployment will be at or near 4.5, right? So we're sort of pretty close to the unemployment rate being at full employment. This chart isn't as happy as it was before we went into the recent spike. This chart is showing what we're expecting, or the bank is expecting to happen to the trimmed mean in the forecast period. Yes, at the end of the period, we would be back on the assumption that interest rates change the way the market thinks they will. The market thinks there'll be one further reduction in the cash rate next year. That's the market's expectation. I'm not saying that's what's going to happen. That's what the market thinks. Well, if you take that assumption, then inflation would be finishing up there at around about 2.6. Well, 0.1 between 2.5 and 2.6. But the bank is charged with reaching 2.5. Anyway, in between now and then, you can see that we're expecting inflation to actually pick up again. This is trimmed above the target range of 3. That's the impact of what happened in September. That's quite significant. And it'll gradually work its way through the data and come out the other side. But if anything, there is still an inflationary impetus in the economy. And really, the only way for us to deal with that once and for all is to drive productivity growth. You hear enough economists talking about that. And that's the reason why. Unless we get productivity growth up, we can't see living standards rising at the level that we're used to. And importantly, we'll have a tendency to inflate. That will be very hard to drive out of the system if we don't increase the rate of productivity growth. Nonetheless, those two charts taken together, and I would say this, wouldn't I, as a board member, I'm going to say, well, you know, we're pretty well targeted here, Treasurer. We're heading pretty close, if not exactly, to what we've been asked to do by the Parliament, but it's going to take a little bit longer to get there than we had thought it would, on the assumption that the interest rate goes down again by 25 basis points next year. And you might say, well, that mightn't happen. And if that didn't happen, well, you can draw your own conclusions, I think. John, I'm going to spend a brief time now talking, as you asked me to do, about stability. These are the highlights from the bank's financial stability review. Look, the broad conclusion is this: you know, everywhere you look, you'd think, well, the system really, there's a lot of, you know, tension here, a lot of danger. We've got a lot of public debt. We've got, you know, share prices rising very, very quickly. Yes, that's true, and plenty of geopolitical tension. Wouldn't you think that the financial markets would be really telling you that there's a problem here? Well, the fact is, folks, they aren't. Right? So you and I might be a bit agitated and thinking what's going on. Oddly enough, the people with money on this aren't particularly concerned. But what about the US? Look at all this US debt. Look at all this borrowing going on. Surely we're going to see bond prices, bond yields, you know, go up through the roof. Well, here's a chart of 30-year bond yields. This is what the market thinks, not what Harper thinks or the Reserve Bank board thinks. People with money. And what have they been doing? Actually putting the prices up, not down. So no sign of concerns in the US bond markets. The UK, well, yes, a bit, but for different reasons. And for us, line ball, nothing to see here. What about the other economies on that chart? Well, the French have got some issues. Elsewhere in Germany, the Japanese are recovering from where they've been. But broadly speaking, you could look at a chart like that. Is this an expression of great concern in the financial markets? The answer is no. Well, what about the private markets? These are charts of spreads, as you can see, as well as the gross yields, spreads between private sector paper rates and public sector paper rates. They're all headed south, right? Not north. So you're thinking, but surely people are concerned about, you know, bankruptcies, what's the cost, rising cost of debt, what's it going to do, inflation and so forth. Well, all I can say to you folks is that the markets don't think that, right? Now, you may well say, and this is where the concern arises, but they could change their mind suddenly, right? Well, that's true. And if they change their mind suddenly, all of these charts go the other way. Well, yes, but you could say that at any time. You could make that claim. Here we are in a set of circumstances where we think, surely now we'd be concerned about these issues. Well, evidently not from the bond market's perspective. So the bank looks at this and says, there is rising tension, there are fiscal sustainability challenges, but the risk premiums remain low. The sovereign bond term premia are all at long run averages. Yes, second dot point, there is increased potential for operational incidents, which is the bank's very clever way of talking about cyber threats, basically. There are the potential for these operational incidents to occur alongside a liquidity shock or some other readjustment of people's expectations in markets. And we deal with that with coordinated intervention by regulators and governments around the world. And you might be a bit concerned at this juncture about the capacity for that type of cooperation, given what, in particular, the US administration has been saying about some of this regulation. And that's a thing to be concerned about, arguably. You put it on the list. But is there any sign at this stage that that is, you know, causing widespread concern? Well, the answer is no. There are persistent weaknesses in the property markets in China. The Chinese economy is rebalancing, even though it's moving its exports away from the US, it's rechanging. It's also trying to stimulate Chinese consumption in order to have a more sort of domestically oriented economic basis than simply export basis in China. They're in the midst of doing that, which means that the property sector is still vulnerable, and that can have a wide knock-on impact to the wider Chinese financial system. But at this stage, there's no sign that the Chinese government isn't managing that. There aren't widespread fears that this will suddenly break out. Could it? Yes, just like people changing their minds about risk premia. But there's no sign of that at the moment. But what if something did happen? Well, the answer is that our banks are well positioned to absorb large loan losses. They're heavily capitalized. We would continue, the bank in particular, to support them in their lending to households and businesses, as we did during the pandemic. We can do all that again. The balance sheet has been repaired sufficiently to manage that if we had to. The superannuation sector is massive, as you well know. In the global financial crisis, it came to the aid of the party. It's even bigger than that now. Having said that, the superannuation funds still need to be concerned about their own liquidity and operational shocks, or their own capacity to be afflicted by cyber shocks and so forth. That's all true. But we shouldn't ignore the fact that the superannuation sector is also there to sustain a major financial shock for us if need be, as they did last time. General insurance is all well capitalised and profitable. Insurance itself might be a bit unaffordable and the availability may become an issue over time, but the insurance companies are all looking fine. And the household sector has strong financial positions. Notwithstanding all of the reductions in real household disposable income over the last couple of years, and notwithstanding interest rates having gone up and all of that, throughout that process, and still it's true, people are making payments, those mortgage borrowers are making payments into their mortgages above and beyond what they're obliged to make, even now. Right? So the savings rate has been rising, household wealth has been growing. So the household sector is in a very strong financial position. Maybe we'd like them to consume a bit more so that we could invest a bit more. But if you're asking, are they so burdened by debt that they could just be knocked over with the slightest breath of wind? The answer is no. And because the answer to that question is no, it's also true that the Australian banks are well positioned to absorb these loan losses given their own exposure to mortgage holders. So you look at all of that, and this is the tenor of the Financial Stability Review. It's not exactly nothing to see here. There are things to see, but bluntly, there are no signs of shock or panic or concern within the financial markets, who are generally most sensitive to these things because they've got money on it. And there are objective reasons for sharing their view that at this stage, there's not a lot to be concerned about. And if something did happen unexpectedly, then we would argue we're in a pretty strong position to manage it as we did during the pandemic. John, I'm happy to leave it right there. I think he's still taking notes.
Unmute, John.
Oh, he's been addressing us. I see.
Thank you, Ed.
Right.
I'll start with a few questions. One of the key issues is this natural rate of unemployment, the non-accelerating rate of unemployment when it for inflation, the NAIRU. This has changed over time.
Mm-hmm.
And when was this last updated? Because it's such a central anchor in your logic. And so
it is, John.
Please defend the
Let me dilate on that.
Please.
Okay, so it is important for folk to know that yes, there is quite a strong contingent of very respectable colleagues of John's and mine who have a view that the natural rate of unemployment or the non-accelerating inflation rate is actually below 4.5%. And so they're going to argue that the bank has monetary policy too tight. And they do, right? We are in reasonably regular contact with these folk to make sure that we understand where they're coming from. And the bank, if you read some of the statements even that Michelle has made, the governor, but others, we calibrate for the fact that we could be wrong. We calibrate for the fact that we could be wrong. But importantly, if the natural rate were lower than 4.5, in other words, let's say, I don't know, it was 4 even, and therefore we've got monetary policy too tight, folks, you would not see what's happening to inflation. And you would not see what those models, so, for what they're worth, are predicting in terms of output gaps and unemployment gaps. You just wouldn't see that. So at some level, it's a debate, John, which goes on amongst the economists. And I guess I can just assure this audience that the bank does not, close its eyes and its ears to what serious commentators are saying. We calibrate for the fact that we could be wrong, and we regularly ask ourselves the question whether we, are on the wrong tram here. And we have a whole series of other sorts of data we look at, including obviously what we get from Liaison. And what you're hearing in the statements the bank is making, and what I've given you tonight, is where we've landed on this. But it is under constant review, John, because as you rightly point out, that's a bit of a lodestar. If we get that wrong, right, we could end up not coming in through Port Phillip Heads, but landing straight onto the beach at, somewhere close. Yeah, where we shouldn't be.
Right. Okay. I've got one more question, and then I'm going to throw to Brian Timms. But Brian might also pick up if Jeff Metz has put his question on the chat function. The other question is financial stability. Last time this was an issue was the global financial crisis. Where did the global financial crisis start? Answer: in the US with mortgage securities and financial derivatives, etc. And this started out as something we all thought, yes, it would probably be limited to the US. It might spread a bit. Well, it spread a long way, and particularly into Britain and the UK and Europe, and it affected everybody. And so at the moment there are concerns over some of the private credit markets or credit providers in the US, and there are concern over some of the regional banks. Is the Reserve Bank monitoring this, or is this an overstated, startling the horses?
Yeah, no. There are reasons. There are good reasons to be concerned there. Last time, John, the transmission primarily to us, if you set aside the exchange rate, was through bank funding costs. Right now, since that time, not only have banks become more richly capitalized, they're much less exposed to international sources of funding than they were. Now, you might argue that means that, they're much more funded by deposits, and there's other sides issues to be raised with that one, but the banks are not as exposed. So that, together with the potential for regulatory intervention, I think it's fair to say the bank is not worried about that, but you have to watch it. I think the bank is much more concerned about things that could develop, for example, in markets for decentralized finance, things like stable coins and such like. That could transmit a whole lot faster, and it could produce something that everybody is familiar with from history, just straight out bank runs, like what happened with Silicon Valley Bank and with the stable coin Terra USD, which was just essentially, wiped out more or less overnight. The fear is that your classic bank run scenario, which is as old as banking, could happen, but happen with lightning speed. And the difficulty for the bank is that at law, it can lend emergency funding to solvent institutions, illiquid but solvent institutions, right? When things happen very, very rapidly, you can't be certain whether the institution is solvent or not. And that's something which exercises the concerns of the bank and the directors who have to sign off, for example, on making these sorts of emergency loans of public money.
Right. Thank you very much. I'm not going to take any more questions from me. I'm taking it. Brian, over to you.
Brian,
can you pick up Jeff?
All right. Thanks, Ian. Yes, look, we'll go straight to a couple of questions that are coming through now. I guess given the way we've seen debt rising throughout, as your slides have said, and stock markets are pretty high, and we've got gold going very fast upwards. Maybe you might make a comment on that later one about gold.
Oh, about gold. Well, interestingly, some of that is being driven by central banks buying gold again. Right? Not us, I might add. But there have been some concerns about particular central banks in certain areas that if they get into, well, bluntly, if they fall out of favor with the US administration, they may need to resort to something else to settle their debts. Now, I'm not going to say that's not the entire story with gold, but there is an impetus there that has helped gold along. Other than that, it's like a lot of other assets. People find a reason to buy something else when they're concerned about what might be happening to bonds or stocks. So that's just the normal financial market doing its thing. The biggest source of concern is that there's a sudden adjustment to long-term bond rates, and that would adjust stock prices downwards very rapidly. Right? And the question there is, well, all right, there's a big supply of US government bonds coming out into the market. What's happening to demand? That may be where this stable coin business comes in. The stable coins, including the US administration, looking to the stable coin market to become a whole new source of demand for US government securities, partly to try to secure the role of the US dollar as an international currency, and partly just to absorb the supply of US government stocks. If that demand grows strongly, as many of them hope it will do, there'll be no adjustment to bond prices. They'll be fine. No adjustment to bond prices, no adjustment to stock prices, and we just keep going. Could this all stop suddenly? Arguably it could, but no one's prepared to call that. And at the minute, the market seems confident enough to let it go.
Okay, David Gilmore has asked here that given the tariff changes that have gone on with the US, have we still got that time for that to flow through? Or it's been 6 months, but are we there yet?
Yeah, well, it's look, it's a good question, Brian. Most of us were saying, yeah, well, wait for the second shoe to drop in the second half of this year. Well, it's now November, right? And I think the three reasons I'm going to give are the same reasons, that it turned out the bark was much worse than its bite. Or to put it the other way, it turned out that President Trump was really using this for negotiating purposes. Fair enough. And that it hasn't ended up being anywhere near as bad as it might have been. The big one, though, is the Chinese have managed to move classically. Trade diversion has helped us out here. And as I said, the third one is that nobody retaliated, right? So the whole thing. But yes, you can see the impact even now filtering through in some of those charts. We will expect to see prices rising in the US for consumers. And I think you start to see the US administration beginning to, regroup in the face of what certain people are saying about their standards of living in the light of these changes.
I wonder if you could make more comments about the productivity issue. If we've got real wages going up and we cheer that, yet here we are saying there's no productivity, where's it all going to go? Has that been influenced by services growing more so than other sectors of the economy?
Yeah, that's part of the answer. The economy is increasingly services dominated, and classically services industries find it hard to increase their productivity. Not impossible, but it's much slower. Goods industries, you can include, you can raise productivity much faster through capital investment. You can do that with services as well, and artificial intelligence is sort of hope of the side in some respects in helping us to do that. The simplest and quickest way to increase productivity, that's output per hour worked, is to increase investment, to increase the capital stock. Not necessarily machines and buildings, although that will happen with data centers and such like, but to invest in capital and tools and technology and IT. It's happening, but it's not happening on as large enough a scale. And you say to the investors, so why have you gone on strike? Why didn't you invest? I said, well, where are we going to sell our stuff? Where's the output? Where are the sales? Show us the returns. And when you then say, okay, well, you can't get your returns. Why can't you get your returns for investment? Well, they'll start listing things like government regulation, right? Inability, and labor costs and this and that. So it is, as the Treasurer rightly points out, it's a bit of a Gordian knot, but we've cut it before today. We have done that before today, and we got productivity improvements through a whole mix of regulatory changes and tax changes, which encouraged investment, and away we went. That needs to happen again. Then you'll raise productivity growth. The difficulty is that if we don't, we have this classic overhang of demand versus supply. And as I said in my presentation, a measure, not hyperinflation, but a measure of inflation gets harder to grind out. And the bank has to stick to its objectives. So interest rates stay there, and it's part of the same problem. People go, it's too cost of living. But we have to compress, cut our cloth according to our means. Can't we increase the means? Yes, we can. How do you do that? Productivity growth. What do we do about that? Away we go with the discussions politically. That's how all that fits. Does that make sense?
Okay, Michael Porter's asking if you could make a few more comments about Chinese real estate and where it's at and what impact that has.
Well, I'm not an
on
expert
the
on that,
economy.
Michael. I sort of hesitate to comment. There are better property experts around this table who would shoot me down. Look, obviously, what the bank does is to watch out to see what the authorities are doing. Right now, the Chinese authorities seem to be sort of a mixture of allowing some of the more egregious cases to actually, face the legitimate consequences of what's been going on. So they're not rescuing them. But on the other hand, they're sending the ambulance to the bottom of the cliff, if you like, and they're trying to make sure that the fallout for local governments and for Chinese consumers isn't as hard as it might otherwise be. The difficulty is for a lot of Chinese householders who find themselves with places they bought that haven't been built, or they can't be built, or they're caught up in that exercise, is that their consumption suffers. And if their consumption suffers, it gets harder to keep the Chinese economy growing. The way the Chinese get out of that is by spending more on investment, particularly through local governments. That's what's keeping resource prices up. That's happening, Michael, continuing to happen. And you may well say, well, surely that's got to come to a stop at some point. Well, maybe. But the Chinese have the capacity to continue to, spend that money if they choose to do it, which they are doing. And importantly, their economy is not suffering as a result of what's been happening in the US. So, they haven't got to worry about that issue. They just look after their own domestic, restructuring of banks and funds that are linked to property.
Okay, maybe one final one, John, before we finish.
Yeah, we are over time, but the audience is holding. So the audience has just increased by 2.
Oh, is that so?
So people
by someone who's late
like
to the party.
away.
That's right.
So,
And that, folks,
we'll pick up this comment from this question from Owen Williams. It's, again, all about competitiveness and productivity, etc., and the role of energy prices on this and where it's all taking us. Would you like to make a comment on that?
Well, Owen, clearly, yes, an essential resource, right, for continuing to improve our standards of living is energy. That's quite clear. And we are in the midst of trying to move from one, a transition from one sort of primary source to another, and it's expensive. There are, as you know, people have different views about how rapidly we should make that transition and whether in some respects we need to do it as much as we do and why aren't we taking nuclear, and all of those things are there. The reality is, and I'm not an energy economist either, we have to spend a lot of money anyway, right? Because frankly, the old energy stock has reached well and truly its use-by date. And, arguably, we're going to have to, and you can get if you look at the AEMO reports, you get this in much more detail than I can give you now. But we have to spend a bunch of money anyway. And the costs of keeping a lot of these coal-fired stations going, increasingly, they rise faster, believe it or not, than the costs of providing the renewable. There's no doubt that the cost of generating energy from renewable sources is a whole lot cheaper, of course, because the sunlight and the wind is sort of free. That's not the issue. The issue is transmission and how we get from there to where we are. Could this potentially hollow out Australian manufacturing and some of those? Well, but will it also raise other opportunities for us? Well, there are a lot of colleagues of John's and mine who think the answer to that is yes. We do have a comparative advantage, obviously, in renewable energy, given the sunlight and the space and so forth. So, we ought to be able to make something of that. But this transition will be extremely expensive. I don't need to tell anybody that. But when you go to AEMO and get them, they do the detailed calculations of the net present value of these investments. And the investments will show positive net present value, right, on reasonable assumptions, the whole cost, all the costs of firming, all chucked in there, but all against the background of the assumption that other countries are making this transition too, right? Okay, if we were just on this by ourselves, and some opponents, of course, claim that we are, that's a whole different story. So generally speaking, the official projections and the arguments in favour of the transition that we're undertaking are predicated on the consequences that would happen to us if Everybody else moves in this direction and we don't. And so it is a political judgment as to whether or not that's the case. And well, I don't need to explain that to you. You can see that being played out to some extent on our political frontier. But economically, if the rest of the world does what the proponents say it's doing, then these various investments that we're contemplating, arguably, you can make an economic case for those quite clearly.
Right.
Okay,
Just
thanks,
very
Ian.
quickly
There-
on the
just
competitive
one area
story.
that I think you haven't mentioned at all is the issue of exchange rates
Yeah.
and the impact on our economy and the rest of the world. I think perhaps you should give us a few comments about that.
I can say that. Yeah, Brian. Well, yeah, surely. Look, most economists, let alone a central banker, sort of wanders into exchange rates with great trepidation. Let's just say that the foreign exchange, look, bluntly again, if I were to show you the chart, which I could have done, you can find it in the bank's papers, looking at the Australian dollar, trade weighted, US, whatever you like, right? Nothing to see here, just sitting there, right? And why is that? Because it's just hanging with commodity prices and interest rate differentials, all just leaving it where it is. The exchange rate for us, provided it's sort of left to do its job, is a wonderful insulator of our economy from adverse circumstances offshore. And it's also, I think, indicative that the foreign exchange market has not been doing much in either direction, that even the foreign exchange market dealers aren't particularly concerned about the outlook for the global economy and financial markets. Otherwise, they would be doing things. So I think, you could say, well, in the foreign exchange market is also quiescent. It is also recognizing that it's doing its job, which is right, doing its insulation thing, and there's sort of not a great deal to see there. I'm not going to venture into predictions of what the exchange rate might or might not do. All I'm going to say is that at the moment, and the bank says this, the value of the dollar is consistent with the bank's long-term models, which are driven by interest rate differentials and commodity prices. And, the dollar is where the dollar more or less you'd expect it to be.
Okay, thanks, Ian. John, I'll hand it back to you, I think.
Thank you very much. Can you all hear me? Right.
Yep.
I'm just going to, before I close, I'm actually going to invite Jeff Metz to have a very quick, short question because he's had his hand up.
He's
and he
been very
wasn't using the chat function, and I
I
don't know
know.
why
So he knows how this Zoom works because I can see him, you see.
So, Jeff,
Good on you,
quickly.
Jeff.
Good to see you again, Ian.
Yeah, nice to-
I think we were last together on the board of either the Alfred Hospital or Southern Healthcare Network or Eastern Healthcare Network decades ago.
Sometime back now.
Followed. Over decades, I mean, as a professor of medicine, I know nothing about the economy. But over decades, I've read the leaders of industry saying we need more immigration to fuel our factories and our productivity. And now politicians are saying we've got too many coming through on immigration. Where does the bank sit in the terms of, do we need more workers or do we need less people coming through immigration?
Okay. No, thanks, Jeff. So obviously the bank as an institution has, quote unquote, nothing to say about immigration, right? It does have things to say about aggregate supply, which we've been talking about. And that's how we would come to your question. Somebody who taught me economics a long, long time ago, Jeff, said to me, just remember this, right? Every immigrant to this country brings a mouth as well as a pair of hands, right? Which is an economist's way of saying they supplement demand as well as supply. So economists are going to say that getting more people here, particularly if somebody else is paid for, the most expensive years of their lives, which you as a medical person would understand include first years of life and the last years of life. Sometimes they even go home for the last years of life, but certainly the first years of life, someone else has paid for that. Someone has paid for their education, right? We have a skill-based immigration program, just setting aside the humanitarian stuff for a minute, which isn't by any means the most important bit. Economically, we select these migrants, select them for their skills, and they get plugged in. A lot of the migration that people are worried about with the effect on house prices and such like is temporary migration. This is students who are coming here. This is a business that we're in, teaching students. And they come and they go. But of course, the stock of students at any one time has been growing. That's true. So what do you do about that? Well, it puts house prices up. So do what? Oh, they went up with the students. What about building some more houses? What about building some more apartments? What about saying to the universities, which they do, like mine at Melbourne, you can have more students. You just have to house them. And the universities, well, that's fine. Okay, give us the space. Change the building plans and regulations, and we'll build it. Build and they will come. So I think the orthodox position, Jeff, is that immigration is unambiguously a good thing for the economy. All right. Now, naturally, politicians have to make decisions, as and as citizens, we have to as well, on the other aspects of this. So I'm not saying anything about assimilation and, social tensions. Clearly, those things have to be managed. They can be there as well. But we're a country, if you haven't read Tony's History of Australia, you should. It's a good read, although there are a couple of howlers in there. He refers to President Roosevelt as Frederick Delano Roosevelt for some unaccountable reason. And I don't know where that came from. And also that the fire stick farming is attributed to, of all people, Tim Flannery, and not to Geoffrey Blaney. So there are a couple of things like that. And there's no mention at all of Peter Costello in the whole history of the Howard government that Tony talks about. So I don't know where that comes from. But as far as the rest of it is concerned, Tony's dead right. We're a country built on immigration. So we have the experience, we have the capacity, and the strength of our democracy is not in spite of immigration. It is because of immigration over that length of time. So some of that is my personal view. But as far as economics is concerned, mate, yeah, immigration, we need it for a whole bunch of reasons, but we have to be able to manage that, both in terms of housing and obviously socially. Thanks for your question.
Thank you.
Right. So I just want to observe that as an economist, that the time is 6:46, and we can form a ratio that we've still got 35 people online, which is pretty much a record for being late, but having such a number still online and listening. And this indicates, I think, the sentiment expressed by a number of people that this is not only comprehensive, but a convincing tour de force. So thank you very much. I think we can all say that, and I'm going to say a few other things, but we're all going to clap you silently
all right,
now.
okay.
So
thank you very much. I appreciate that.
Now, Ian is, of course, a club member, and our next two speakers will also be club members. I'm talking about February and March. Our speaker for February will be someone many of us see on television at night, and that is Alan Kohler, and he is going to be addressing the shortcomings in the government's plan or non-plan to deal with climate adjustment. Right. Second, that is in February, we have club member who is an architect, and his company, his modest little company, is putting solar panels into space. He's supported by Sumitomo, NASA, etc. And Serdar Bevan will be speaking to us in March. So another club member. So I hope to see you all online. This is the last session for the year. So thank you all for the support for the Twilight series. And I hope to see you all in the new year, if not around the club at events such as the Music Gala this week or some of the others. So thank you very much. So good night, everybody. Thank you very much.
Thanks, John.
And thank you all to all our guests.
Thanks, Ian.
Thanks, Ian.
Terrific.